Welcome everybody, and thank you very much for joining our webinar this morning. My name is Rose Kervick. I'm a director with Accountant Online, and I'm joined by Gerard O'Reilly, who's a partner at Crowe. And we're going to be talking about how to build value in your business. Gerard is passionate about entrepreneurship and creating, growing, and keeping the wealth in businesses. So we've asked Crowe to join us previously, and it's been a very popular webinar. Anybody who's joined us today or anybody who's signed up for the webinar will receive the recording along with the slides and Gerard's contact details to follow up with any particular questions you might have put directly to Gerard. And meanwhile, throughout the course of the hour or so that we'll be talking through these issues, you can send me some any messages about your own situation that you'd like Gerard to respond to, and I'll be moderating the Q&A and the chat. So feel free to just drop your questions in that chat and let us know what's on your mind. So I'll hand it over to you, Gerard. Thank you very much for joining us this morning.
Thank you very much.
Great. Yeah. Okay.
Okay, so I'll get started then. So just to reiterate, really, we were saying there. So look, we're a top 8 firm in the world. I mean, maybe people might have historically known as Bass or Charlton, but anyway. So look, what we're predominantly about and what the business has grown on over the last 75 years is really on Indigenous entrepreneurs, so I suppose what drives us is creating, growing and keeping and helping people hold on to that wealth. And I mean by holding on to it is just the various tax issues which arise, which you really just need to plan carefully for, but I mean, not failing to plan at an early stage, actually, it can be detrimental. So what we do is, like, first thing is this program is about here, or this talk is about, is building that value. And we take you through sort of coaching, mentoring, monitoring, controlling that. If needs be, raise finance to make it happen. Bespoke tax planning, which I think is very important, and then ultimately exit. So really what I'm trying to do is really get you to focus on 3 questions, really. So why are some businesses worth more than others? I think we've all seen the big headlines in the papers of businesses which sell for billions, and we wonder why.
Yeah.
I mean, I do remember when I think when Google was launched, which must be probably the best part of 10 years ago, I don't think it ever made any money, or indeed Facebook,
Yeah. And Amazon didn't make money for a long time.
Indeed. Yeah.
Yeah.
I mean, it's really, Amazon is one of the first movers, but it's really in the last 10 years that it's particularly added a lot of value. So what was its secret sauce? And what can you do then taking those lessons? What can you do to create value for yourself? So I think one of the people I would follow is a fellow called Simon Sinek, and his thing is always, if you really need to understand your why. Why do you want to do this? Because that's really what will drive you. It's sort of an inner burn to which will keep you focused on creating that value. So I think this is the first thing, is so really, when you look at your business, do you see it, well, look, it's never going to be worth a lot, but I can make a lot of money in the interim. So it's a cash cow on the pension plan, put some savings, maybe grow some assets. Maybe you want to pass it on to the next generation. Maybe you see a management buyout, MBO, so pardon the lingo. Or maybe, look, what's driving you is there's things you just want to do, so the proverbial bucket list, or just other things you want to do with life. So if you understand that, then I think that can then mean that you're ready and able to make maybe the sacrifices, the commitment, the engagement that's necessary to create that value. And I suppose having created the value, to be tax smart about that, because there are many pitfalls that can leave people in a situation where they've created the value, but it ends up being taxed at the highest rate of income tax, as opposed to in some cases being zero if you avail of retirement relief, so Do you want 0 or do you want 55%? So I think that's a rhetorical question, I think, Rose. What do you think?
I think there's a
Yeah.
probably
So
pretty easy answer to that. Yeah.
yeah. So first thing I really think you need to do is think about where you are in the type of um, entrepreneur. And trick way of or simple way of figuring this out for yourself is that you take out your business card. Do you describe yourself as doctor, dentist, plumber, consultant, accountant? Then you're a craft worker. You are what you do.
Okay.
Um, Freedom fighter would be the business card would say things like business owner, managing director, CEO, that kind of thing. And the serial entrepreneur more than likely doesn't have a business card, because he doesn't need one in a lot of ways. I've come across many a serial entrepreneur who says, I forgot my business card. Can I have yours? So wary of those individuals that they think they're forgetful. In actual fact, the last thing they are is forgetful. Very well organized, very focused. But essentially, a serial entrepreneur is wants to build and grow a business and essentially sell it on, and then maybe start again and do something else. So you'll see that's more and more. You'll see more and more of those about, obviously. But the freedom fighter is essentially someone who never sees themselves working for anybody else.
Okay.
They are. And consequently, more than likely, you're going to stay in the business right until the very end. So there'll be a one business person, so start it, grow it, keep it, nurture it, and then at a certain time exit. But wouldn't see themselves necessarily going into other businesses. So just maybe think about yourself in a way there. So
Okay.
the bad news is, I suppose, is that a craft worker business, if you like, will find it difficult to sell the business for more than about 2 times profit.
Okay.
And the main reason is that it's very hard to defend, so,
Yeah.
or indeed is not repeatable. I mean, the common example I gave here is the brain surgeon, so can make a lot of money, but, really can't sell the business. So the attributes first up attribute you have to have in any business, to be sellable, is that it has to be independent of you,
Okay.
the owner. Cash flow positive, and I don't mean just profitable, I mean it's cash flow positive. So I mean, if your business is constantly having to reinvest and all the profits go into more and more working capital or more and more machinery or more and more other type of investment, then it's not necessarily generating cash. And if a business isn't generating cash, ultimately it'll go out of business. And ultimately then lastly and profitable, more than just your income. So I mean, why would someone buy your business if all it's doing is paying your salary? So it's all it's going to do when they buy the business is pay their salary. So it has to be worth more than that, so just keep that in mind. So that's
how could it be independent of owner though if you are the brain surgeon?
That's the challenge. You cannot sell that business, so I mean, if it is a challenge. I mean, there's an element of here which is probably difficult to do, but I mean, building a management team, creating something perhaps which is, I'm thinking here, where we all buy online these days. So you download it, I suppose I'm just picking this one. I've no reason particular, but maybe because I got into buying it, it was ancestry.com, €10 a month or whatever. So somebody developed this program, but it's click and collect, like it's independent of the owner, and it may only have one man and a one person and a dog behind it, but I mean, it's just generating cash every month, So.
But that's not a craft worker, is it?
It's probably not. I mean, it's moving a little bit beyond that, but I mean, I think it is the challenge for any craft worker to create a business, so be it a printer, a solicitor, anybody who's, is that craft worker to actually create a valuable business that can be sold is challenging. There's no doubt. So,
and it's only still going to get 2 times profit.
More than likely, because it is difficult to defend. It doesn't have a lot of the other attributes, that you need. It's. I think if you move on, I'll develop that idea a bit further as we go along. But it's. But these are the first things, really. Any business needs to have, to be worth something.
Sure.
The next one here, the freedom fighter, and this is your atypical business that you would see selling for 5 times profit. Five is sort of like a number that people use to say, well, start at 5. There's a reason why to discount it lower or indeed
Mm-hmm.
make it higher. So, so in this case, I think we've all seen business which are dependent on a particular customer or supplier. Customer satisfaction, obviously, where that there is a marketing engine there which is driving future business, and is making the business frictionless, so that it can grow quite well and without too much intervention from the owners. It's
Yeah.
a systematic approach and structure about it. And then it has to have growth prospects, because if someone's going to buy your business, they got to feel, well, you've taken it to X, can they
Yeah.
take it to X plus plus? So that you've got a model, a structure, a business model, an outlook which can be scalable. So that's what people buy. So they and clearly you move from 5 to 6 to 7 if you have a business which is more scalable and more protectable. And I'll get onto those in a moment.
Right.
But so if you go for 10, this is if you want that serial entrepreneur, so you build it, and we'll see this again and again. I mean, every day I'm opening the paper and I see another born on the internet type business, which has attracted a lot of capital or
Yeah.
sold for substantial numbers.
Yeah.
And it has these attributes, which is recurring revenue. Take my ancestry.com,
Yeah.
so or Netflix or any of these businesses. This is the new attribute that over the last 10 years, which has it's been transformative in driving value in businesses. And IT businesses which have not gone for a recurring business model, ultimately, they don't achieve that value potential, and they go back. And I'm thinking here about maybe like just in our industry, we would see a lot of accounting packages which would have been sold and installed and maintained. And now the new model is cloud-based accounting systems. So the cloud-based accounting systems charging everybody 10, 15, 20, 25 euro per month per user, and compared to maybe a package that would have cost maybe 10 or 12 grand. So the recurring business model is the one that is most attractive to a buyer, because it gives predictability and stability, but equally it allows it to be scalable. So, and equally, if you can control your market, be it, this can often be, not that you're not replaceable, but if you can control an aspect of your market and just take the ancestry.com for want of a better one, or indeed Netflix. If you get in first, you have that control, might be too strong a word, but certainly you have a dominance in the marketplace, which is difficult to shift. Therefore, you're defendable. If you go back to Warren Buffett type situations or discussions, Warren Buffett would always talk about having a defendable moat around your business. So it's an attribute of that, which is, it's not monopoly, but it is a situation where you have a great deal of control of your market. And then independent of key employees, so I mean, if there's anybody in your business, and I did have this as a particular example in a business I sold a few years ago, where some key employees were very influential with some key customers, and long story short is that the owner had nowhere else to go other than sell it to the employees at a discount. So put for want of a bit of planning and maybe 2 years preparation, probably sold it for half of what it was worth. So sobering lesson in that for all of us. So just putting all that together, so just trying to, there's no one thing here which will make it, the golden shot, as it were. But I mean, I think to understand where you fit in this matrix and how you can actually maybe move up that value chain, and create the value that you're looking for. And some of these are value accretive and others are value destroyers, So I think, if you are not independent of employees or suppliers or customers, then, they're value destroyers. Whereas what I'd like to focus in on, if you'd like to, the priority ones, if there was one thing I would say to do, or things that you should focus on, is these three attributes, because these will be the ones which will make the most difference in terms of creating value. Because you need to be independent of the owner, and because whoever buys your business doesn't want to find, well, the customers no longer want to deal with the business because they're used to dealing with you, so you have to make the business independent of you. Being growth focused obviously will attract a higher multiple, and recurring revenue just ensures that stability in the business over a longer period. And just to put that in a bit more context, just to be the money ball, so independent of owner, growth prospects, recurring revenue. And what makes the business, if you think about those things from an owner, from a buyer's point of view, do you have a business which is teachable, defendable, scalable, predictable? So, so McDonald's would have always talked about a business where, you get that burger down, it's this size, it's this weight, so you can teach it, you can teach people a particular task that they can do in a repetitive way. Now, that's not always doable in business, but I mean, I think if you are a people-based business, it has to be something which is teachable and therefore can be repeated with good quality and repeatable quality, defend on an ongoing basis. A defendable business, one, like I say, where you have that customer satisfaction or indeed control of your market, and therefore, because if it's not defendable, then you don't really have growth prospects. I mean, I'm thinking of one client of mine where he's forever creative, but he's forever copied by his competitors. So he can't, in a lot of cases, get that march ahead of his competitors, and therefore, finding it difficult to defend that business. Being scalable, obviously related to growth. So what we mean here is that it doesn't tie up a lot of capital to grow it. So if your business, as you have at the moment, if you were to double the size of that business, does it mean you have to buy more machinery, take out more bank loans, more money tied up in stock and other working capital? Then there are breaks on the scalability of that business. Another break on the scalability is that if you, as the owner, and there's only one of you, then you can't really scale if you are the business. So it has to be independent of the owner and that to be scalable. And the predictable bit is, like the defendable, you have to be able to have a good understanding that, a lot of your revenues or your other aspects of your business are controlled as you go forward, because that gives you and it gives a potential buyer the confidence to have a predictable business and profit stream. And obviously, the more predictable the business stream is, and the more predictable the profits are. I see a typo there, pardon. But the more predictable it is, then clearly the more it's worth. The example here typically is your toll bridge. So a toll bridge. There's not many other places to go. You have to cross that toll bridge, and it certainly is independent of the owner, and it will have a predictable recurring revenue flow to it. So they're the sort of things I'd just get you to focus on, maybe.
Very good. We have a question from Jean Paul, and he says he's starting an online affiliate marketing business from scratch. I haven't created any revenue yet. What is the number one thing I need to focus on to make it generate income within the next few months? Now, generating income is not really what we're going to talk about, but you're here because really you're talking about probably you may be setting out on your journey to set up a business. So you're really setting out the principles for what we need to develop, how we need to develop our business. But really, it sounds like a sales and marketing question in terms of what he needs to focus on to make it generate income. But recurring revenue is the most attractive, isn't it?
Yeah,
is the one. Yeah, recurring revenue. So it's an affiliate business. So something that I mean, would relate to recurring revenue would be very strong partnerships, I suppose.
Yeah, or subscriptions. I mean, it would,
Yeah,
I mean, if you, I probably need to know
subscriptions
a little
is
bit more about
fantastic.
the,
Yeah, yeah,
yeah, I mean, I think, again and again, when we're drawn into subscription models, I think
yeah,
there is I suppose, there is a certain pushback from in a consumer business. I think consumers, there is a pushback against yet another subscription. I think we're
yeah,
all stuck with
yeah,
these in our bank statement saying, what the hell did I do that for?
yeah,
How do I cancel this
exactly.
one?
Yeah.
Um, so,
Nevertheless, it's an affordable solution for a consumer because we
yeah.
pay on a monthly basis. It's a small
Mm.
amount. Netflix has kept us all more or less sane over the last year. Uh, and
Indeed.
for Netflix, then it's recurring, so it's predictable, as you say.
Yeah.
So
But and it means they can reinvest, I mean, like when
yeah,
they, with all the marketing knowledge they have and the analytics they have, they know pretty much if they produce product X, they know what the market is and who will actually buy it,
yeah,
so that recurring revenue gives them the confidence to invest
yeah,
in their business,
yeah,
and come out with new product. But yeah, I think it's to go back to John Paul. I think understand the value you're offering that customer, and I do
yeah,
suspect there is a moment of truth there. I mean, we can all do things for free, but
yeah,
I do think you need to think about that revenue model. And the moment of truth is when somebody pays for it. There's no greater moment of truth, as it were. I mean, there's we're
yeah.
all, I suppose, we're online. We got used to getting a lot of things for free, from newspapers or otherwise. And I think that's not a model which is ultimately
No,
sustainable.
no.
Um,
Another question from David, which is always a question that I have actually, which is there are companies with no profit while generating big revenues but
yeah.
they're highly valued,
Mm,
um, certainly more than 10 times profit. So if there's no profit, of course, it can't be
yeah.
valued by profit. Would the future profit still be a relevant factor for any investor in these companies? So I suppose in that scenario, Amazon would be a good example. It was
Yeah.
very valuable, wasn't it? Even though it didn't
Absolutely.
produce profit. Yeah.
Yeah, I mean,
So
and Netflix and LinkedIn. LinkedIn sold for what, 29 billion or something and never made a penny.
didn't
Um,
it make any profit? Wow.
yeah, I mean, Microsoft have it
Gosh.
now.
Yes.
So but likewise Facebook.
Yeah.
So yeah,
It is a
I mean,
factor.
the trick,
Yeah.
like ultimately, the people who, we look at these numbers and say someone is crazy here. They don't know what they're
Mm,
doing, but
mm.
you can be damn sure they know exactly what they're doing. And
It's
the
this predictable element, Jared, isn't
yeah,
it?
well,
That you can forecast out and see
mm,
predictable recurring
that's
revenue.
exactly what it is,
Yeah,
because you see a scale, you see this business
yeah,
scaling. I mean, go back to, as I say here, scalable. So, you take your Netflix or whatever, it doesn't cost it any more money to add a new customer, and it's
yeah,
immediately cash flow positive. So
yeah.
you look into
Wonderful.
those
Yeah,
businesses, you know what? It is all about, that belief that you can continue to scale that business.
yeah,
And there was a business a good few years ago, I remember, which was on this particular growth curve, scaling up. And the people who bought into that business bought into it while it was on that rising curve.
yeah,
But at some stage, it leveled off. And
yeah.
immediately, strangely enough, immediately it lost value. It was making more money than it was when they bought it, but
Okay.
immediately lost value because they couldn't see the future growth
Yeah.
curve. So the magic here is that when we say someone's buying a business for 5 times or 10 times,
Mm,
when they're buying it for 10 times, what they're really buying is it's 5 times future profit,
yeah.
so what they
Okay.
believe that future profit will be delivered. So,
Yeah.
be it a Facebook made no money, once it got to a stage where it created an income model or, an income stream, then it instantly became profitable because
Yeah.
all the infrastructure was there. All just, so
It was
it
proving.
was
Yeah. That.
proven, they
Yeah.
had a captive base. They were in a position where it was very hard to attack them having created that scale that they were, had a defendable business, and it was very difficult for
Yeah.
somebody else to replace them, unless they obviously mess it up. But
Yeah.
that's they had that defendable business proposition. So that's what it's about. I mean, these are hard-nosed people buying these businesses. They're not sort of dreamers who, just lost the run of themselves. So keep that in mind.
Okay.
There's a very valid reason why these businesses are valued at that level.
Yeah.
So just taking that, I mean, I think, where are you on this, and how do you step up to the next piece of that, creating that value? So just to really maybe reflect on where you see yourself, and equally, if we go back to here, what are the things you need to do to sort of get yourself on this road?
Yeah.
So, so I just want to cover here just something that, I think is very important in looking at your business, is deciding who's likely to buy it, because, there are different attributes to each one. And I'm thinking of a particular business who made it part of their plan to go to trade shows where their competitors were. And they didn't go there to sell product or indeed to get new distribution agents. They went there to get under the nose of their competitors and get noticed. And therefore, because they saw a competitor was a likely place that they were going to sell. So, having a strategy about what your exit plan is very important here. And I just say, if it is a competitor, a lot of people don't want to sell to the competitor because, they feel it's maybe a little dent on their ego. But if when you sell your business, you're just selling a customer list or stock or whatever else, essentially you're not selling a business, you're just selling assets. So they're just asset stripping essentially. Which what you want to do is sell a business. That's where you're selling future profit.
Yeah.
There's consolidation and synergies, which can often drive the value there, which obviously the more you're in control of your business, the more you can get those synergies added on to your profit as opposed to theirs. But also, I think if you're looking at a competitor or indeed someone you're going to sell to, you have to move their dial. So there's no point in being a €1 million business that you're trying to sell to a business which is maybe 100 million, because you're not going to change their numbers sufficiently. So you've got to move their dial, so you've got to be probably 10 to 20% of their revenue at least to move their dial, to make sure they invest the time and the energy needed to take on your business. So keep that in mind when you're looking at a competitor. Now, okay, you may have that killer software product or solution. There's always the outliers, but in general, a competitor is not going to look at you unless you're going to move that dial. If it is the management team, and this would be quite common in management buyout, and this sometimes works with private equity, but just keeping it separate for the moment. So this is quite common. I mean, but obviously you've got to build that management team. They've got to have the capabilities and the skills and the wherewithal to run a business. In other words, they've got to think like a business owner. And they aren't always there. There's often good management people, but they haven't grown into being entrepreneurs, driven to take a business forward. And what I often find in this case is that it gives the opportunity for the manager or the owner to progressively move out of the business, to build that team, to be a bit stronger. And clearly, obviously, whoever's funding that management buyout, they have got to have confidence in that management team as well. So just bear that in mind. So it's that takes a while to build and create, but it can be done. Interesting enough, there is, with the money being a lot cheaper than it was, there are funds available for the right team, opportunity, and so on. Be it banking or otherwise, private equity, etc. If you take a private equity term, and this is like you're seeing this more and more in Ireland, and I think there's an awful lot of concern about vulture funds and whatever else. The byword really for private equity people is that they are investing in you, and they're dependent on you to do the things because you understand your business. They don't, but they understand how to grow your business probably better than you do, and indeed, critically provide the funds. So they will provide that strategy, the access to funds, allow you to build that management team, And ultimately, let's be clear. I mean, they're focused on an exit and making monies out of this. So it should be a win-win, So there's a lot of concern here. Yeah, it imposes new disciplines on the business, absolutely. But equally, it does create the opportunity maybe to bring that business to the scale that you're looking for. One other aspect of private equity, which is should be borne in mind, is that it can be an opportunity for you to take some money off the table. So, I mean, if all your wealth is tied up in your business, you might be concerned about that next investment. So you might just hold back. Whereas if you've managed to secure your own wealth, i.e., cash in some of the value you created, and the risk capital is provided by the private equity, you might be more confident in taking that risk because they're taking it with you, So that scalability, taking the risk away or de-risking for you for some degree, allows you to consolidate your industry and thereby create more value. I mean, I think just as an aside, I mean, we talked about sort of 2, 5, 10. The more you can consolidate your industry and you become a dominant player and therefore control your market, the more valuable you are. A lot of multinationals, as an aside, would say if they're not in the top 3 in their industry, they exit. So you obviously
Okay. Yeah.
exit or
And
multinational businesses.
Gerard, just for the business owners then who are participating today, for some people it will they will be at the start of this journey, and it might be 5 or 10 years away or longer before they'd consider this. But putting those building blocks in place.
Well, that's it. I mean, I think you've got to go back to where we started with here. Is why do you want to do it? What do you feel you can achieve in your business? So what's going to drive you? Then understand the attributes which are destroying value, and understand those ones which if you are the owner and you're in the owner's trap, you've got to make it independent of you, and then you've got to create those things which will grow that value. So this does require planning, and I think this is very much what this program we would have is about. This is not just turning up on the day and saying, I want to sell it, or someone has approached me. I'm 64 and a half years of age and I don't have a pension. I need to sell my business.
Okay.
You're in a bad place. You need to start this journey. I would suggest, if you are that freedom fighter who's exiting or hoping to retire out of the business, you really need to start it probably no later than about 52, 54, to really get to where you want.
There's a question from Peter about that. And he asks, can a craft worker move the business up the value chain and still do their craft? Do you have
difficult?
Yeah.
Ultimately, you've got to be, to use a hackneyed phrase, you've got to be working on the business rather than in the business.
Yeah. That can take time, can't it? You need to build your leadership team. Yeah.
It's if you are the person who is, that's brain surgeon, there's no scalability opportunity. There's no, you are the one who's generating the value, so.
But you could hire a few brain surgeons, couldn't you?
I mean, having said that,
set up the brain surgeon business.
There would be all this microsurgery being done from various parts of the world.
Yeah. Could have it remote in.
Exactly, yeah.
Peter also says, do you have any tips? He said, do you have to step back and create the systems to do it without you? So I suppose yes is the answer to that. And any tips on maintaining control while doing so? So that's a really good question, isn't it? As you're maintaining control while stepping back.
Well, it's as basic as systems and processes and procedures, so quality control system through to credit control system, and going back to, I mean, book I'm sure some people have read is the E-Myth, it's just like, how do you create entrepreneurs, and I think it is a question of, you don't, I mean, there's processes and structures about how you go about these things. And McDonald's demonstrated this, that, they produce the same burger in whatever it is, 180 countries around the world, and probably what, 100,000 or 200,000 stores,
Always taste the same. Yeah.
It all
Yeah.
tastes the same, which is
Yeah.
obviously is great, when you're in some
Yeah.
place you don't know, but equally, has its limitations. But you got to understand that what you are as a value to your customer. So McDonald's has a value to us all, but equally, it's not the experience necessarily we want every day.
But
So.
just for Peter's response to Peter, that book that you mentioned, the E-Myth, maybe not everybody knows it, so I'll pop that in the chat as well, because that's quite a famous book, isn't it? About those challenges that Peter outlines, which is like, how do you move up the value chain there and take on those different personas? It's a lot about leadership, isn't it?
It is, but but it's having that vision of what you're trying to do and like what are those building blocks, so
yeah.
So if you are a genius at what you do and much sought after, how do you create 5 of you? So you gotta you can train, build a management team, trust people, a lot of learn it's the management skills and the people skills that make the difference.
So that book is The E-Myth, and it's by Michael E. Gerber, Gerber. And its subtitle is Why Most Small Businesses Don't Work.
Yeah. Like, it's a fascinating story about McDonald's. I won't bore people with it, but it's just the guy who generated all the value and created the real business wasn't the guy who invented the burger.
Yes.
He just saw how somebody else was doing it, and he bought their business. So so just a couple of things. It's okay. I'll move on. I mean, if there's other questions,
please do. Yeah.
Happy to take those, Rose. But just
keep going.
What we find is that, and this may sound ridiculous, but at the age of, if you're coming up to your 55th birthday, you may be celebrating, but you may have, when you cross that threshold into 55 years in one day, you may have actually already cost yourself a huge amount of tax by not doing some very simple things. So that's why at 55, you can damage how much you can get by way of retirement relief. At 65, you can damage it even more. And 70, you can create other problems, So and there's not a lot of people are focused on this particular aspect, So, the typical situation there, I'll just very quickly cover it, is, if you are a business owner, it wouldn't be unusual. You have 2 shareholders. The main driver has 99%, and the second person, possibly a spouse, has 1%. You only get retirement relief on your piece. So, and that's capped at 750,000. So if you have a business worth 1.5 million, you may end up getting no value whatsoever out of retirement relief. But on the day before your 55th birthday, if you had split the shares between you and your spouse, even if you make it 51-49, you effectively have double the relief to 1.5 million. So it's not as simple as that, but I mean, these are
very good
irreversible
points.
moves, irreversible mistakes that people can make. So never too early to get started to do a bit of tax planning around this. You need to know what you need to live on and what the surplus is, because I think once you do that, then you can get into some interesting tax planning as well. Pension as a wealth creator. I mean, I think most people know that you can build up a pension fund, but just think of the pension fund as if you went and bought property. It's just a place to store money tax effectively. Now how it's invested and how it's lost and gains value, that's a separate question, which I think, I think, Rose, you were saying you have other people advising on that. So, but I think they probably make some of the same points about that. Property as a tax opportunity and as a penalty. So just be careful of how you treat property. Retirement relief and entrepreneurial relief, like how they affect you. There are different rules applying to each, but you need to understand them. There are, particularly in the last couple of years, a lot of anti-avoidance, punitive tax legislation, which is very easy to fall foul of. And this is what I was saying earlier on, that you literally can go from 0% tax, which you believe you're going to pay, up to 55%, purely by not doing the right things. And it could just be not getting bad advice, or not taking good advice on that, So just it's a fine balancing act between what you want, what a bank will support, what a taxman would be happy with, and what can be achieved under company law. So, none of us want to fall foul of those,
Sure.
So, and then just lastly, I would just say, figure out type of entrepreneur you are. What one change can you make to create value, and identify the type of likely buyer that you'll be attractive to. Um, and then just, I think once you're creating value, these problems are all solvable. If you're going to hold on to that value, i.e., the tax stake, then you need careful planning. And I mean, to be a bit morbid, you can't take it with you. If you think you're going to stay in your business and dive your boots on, that's fine.
Okay.
So yeah, that's me, Rose. Hopefully, I haven't taken up too much time. So
Very good. That's great. Thank you very much for that, Gerard. That's really good reminders there. So while we have the participants still, if you want to drop us any more chat messages in the chat there, do let us know. But meanwhile, Gerard, is there anything? Yes, I would have a question around those private equity companies. So if somebody wanted to talk to those private equity companies, or what would be the be the first step, I suppose, or how,
I think,
who are the private equity companies in Ireland?
Yeah, but like one of the things coming out of the financial crisis is we're all be familiar with maybe NAMA, but a spin out of NAMA is a thing called the Strategic Banking Corporation, which is this government fund which they built up in the good times, and they set out then to effectively invest that in businesses. So the Strategic Banking Corporation of Ireland are the ones funding. I mean, we probably more recently would have seen them under these various schemes that are guaranteeing bank loans and so on. But one of the things they did early on, that is they invested, or they co-invested with private equity funds to create a private equity market, which just didn't exist in Ireland, in the noughties or before. I mean, there would have been very large scale ones, but now it's becoming more and more common. And I think, one of the ones maybe to keep in mind would be Lily O'Brien's Chocolates.
Okay.
From a good few years back. I think about 10 years ago, if I'm not mistaken, it was Mary O'Brien? But Mary, she had a fantastic business down in Newbridge. And, it's, I can't remember what she got for it, but I mean, she brought in private equity, but the private equity people were able to scale that business and bring it internationally. And consequently, everybody made a lot more money out of it, So, but I think to answer the question directly, you really have to have a clear plan of what you're trying to achieve. So, you can't go to these people and just say, what do you think of my business? You really got to have your own vision of what you're trying to do and where it can go. And certainly, to have those growth prospects to be scalable, defendable, all those kind of things, they are the things they will look to, at a smaller scale. You may, or maybe people are familiar with a chain of fast food restaurants called Boojum.
Yeah.
Boojum, I think of them.
Yeah.
But I mean, again, private equity firm invested in that company probably 6-7 years. No, it wouldn't be that. Maybe 5 years ago.
Yeah.
It's allowed that business to scale. So I mean, it is focused on casual dining, students, so on. But I mean, on the market there, they found a structure, a product, a system, an approach which they could scale. And I think that business has gone from strength to strength. So
they started out with that in mind. They built their structure, with that in mind. So, Gerard, the last question then for you is, you have a program, do you, in Crowe, where you work with business owners?
That's it.
Okay. Could you tell us a bit about that program?
Yeah, sure. Yeah. I mean, I think we will cover all the topics we cover here. And I think obviously some apply to some businesses more than others. So it's essentially, first part of it is doing that diagnostic, exactly where do you fit in terms of all these attributes, and then from that, you're working through a program to say, well, okay, here's a step program to eliminate some of those value destroyers and equally to build that growth, build that
Okay.
and really, figure out where the business can go and how you create a scalable, defendable business. So that's, yeah, so it's a program. And it really, what we do typically is, there's a 3-month process of essentially going through that diagnostic, coming up with an action plan, and then prioritizing that action plan to say, well, okay, as a business owner, how do you loosen the dependence on you? How do you loosen the dependence on a particular supplier or whatever else? Or how do you get the cash into the business to allow it to scale? So figuring out what are the steps, prioritizing, and then like low-hanging fruit, work on the easy ones first, then start growing and working through some of the more challenging items. And the most challenging items typically is around building a management team.
Yeah. Okay, and then a question from Murad from Unomed. He asks, are EU investors interested in Ireland health startups? Or only American investors are the ones to approach? So it's about approaching investors. Yeah.
There's undoubtedly medtech is something which in the US is much more developed. I think it's probably a function of their private medical health system.
Yeah.
Whereas, I have to maybe share some frustration, I suppose. I mean, it took a pandemic for us to make them wonderful, amazing leap to have online prescriptions directly to our chemists. How advanced technology is that? So the entrepreneurial spirit does create change. Whereas I don't want to be government bashing, but if there isn't the incentive to change, or a need to change, then change is slow. So it is more difficult. But I'm just seeing again and again so many medical type startups or health-based startups which are transformative, working with hospitals or not, but I mean so there's lots of opportunities there. But look, the private equity market in Europe isn't as developed, full stop. I mean, we know that. But equally, to attract those kind of investors, be it Series A, like pre-trading or angel investors, you really have to have a very good concept and good idea. There are, I mean, just to maybe retract a little bit, I find the business innovation centers in the universities very, very good. That sort of giving you those support and guidance, but equally they prepare you for the money ban. So to understand what your business proposition has to be to make it interesting to the money people, is an art in itself. And you may look at things like the Halo Business H-band. But basically, it's Business Angels. It's a Halo Business Angels Network. Sorry, just the acronym just slipped me there for a moment. But it's a very, very good basis if you just want to get Series A, maybe 150, 250,000 to get the idea off the ground and get matching funding then from EI. That's typically where people go. So that gets you started, get you develop your product, develop your market, and so on, and then move it on to the next stage. So, Series B, C, D, and E, and you can, who knows, maybe you'll be one of the Collison brothers or be stand toe to toe with one of the Collisons.
That would be great. And Gerard, just
I think at the last count.
Yeah. So, Gerard, another question around the program that you do. Does it differ from the many EU accelerator programs? So what does it cost, and is it one-to-one? So just to clarify, it's not an accelerator program that you do. It is a quite different. If you could just outline what's involved in that program.
Yeah, like it is one-to-one. I mean, it is, I mean, typically it's been one-to-one. We have run it somewhat successfully where, maybe 4 or 5 people want to work together on it. I mean, I think that's, like I say, we have done that in the past. And the great thing about that is that, there's no substitute for networking with other entrepreneurs, and learn from their successes and indeed. So it does encourage that and come up very well. And that obviously helps with the cost as well, So cost-wise, I mean, I think, it typically, it'd be, you're talking about a minimum of, I would say 5,000 is very, very minimum, and I'm just thinking of one business, and that was just we had a couple of sessions, and it really depends on the work we have to do to work with you over a period. But the initial, you certainly want to invest 5,000 and probably more to, or have a budget to do more, because whatever we divide, sorry, just 1 second.
Okay. You're
Whatever,
having
whatever solutions
competing.
we derive, sorry, I don't
Yeah.
know if you have just a call coming in. So apologies. Yeah, I mean, I think, it's a minimum there, but typically I'd have to say that the average is probably about 8,000 or 9,000, just if, to get that started, so I
Okay.
think, but it does depend on the scale of the business and the challenges you face,
Sure.
Mm.
Okay.
But I mean, I certainly put it out there. I don't know if there is people on the call. If 5 or 6 people want to come together, we'd certainly work with you to develop a program to people can work together. I mean, we could, like I said, we've done it before. We can.
Oh, really? Okay, so you'd do
Well,
like a group
session, yeah. Like I say, where
group
people can work with
discount.
each other. Well, it's effectively, I mean, from our point of view, yeah. I mean, it
Yeah,
would effectively be more cost effective. So, that's
that's
certainly
okay. That might be interesting, Gerard.
Yeah, but
Let's have a chat about that, Gerard, and see, because
yeah.
all of our clients are business owners, and they'll be at different stages of growth and development.
Sure.
But if there's if they're at common stages, that might be a really good idea. So let's have a chat, and then I'll put it out to the audience and see if we have clients interested in doing that. That sounds really helpful.
We did that a couple of years ago with a network group.
Okay.
Who they knew one another reasonably well. So
Yeah.
they had the same common issues, but not necessarily
Okay.
There was one clear solution. I think it's often having the confidence to implement what you believe is the right thing to do. So
Okay.
but sharing those thoughts and that can make a big difference. So
Great. Okay. And another question then: what are some steps a business can take or look into to minimize the tax payments? In particular, a question about what was said at the start. Would you rather pay 55% or zero tax? So
get a good
what
tax
do we need
advisor,
to
and I'll hold our
get a
hands up
good
there,
tax advisor?
someone
Okay.
can help you with that. It is. I mean, I often describe it that that turning your like I say, going from 55 to 56.
Yeah.
It's a Goldilocks moment. Sorry, it's a Cinderella moment. You literally at that moment of midnight. You're back to living in a pumpkin as opposed to a golden carriage. So it like literally. It's just so few people talk about that particular attribute. And it's not as simple as that. I mean, it doesn't apply to everybody, but it's certainly one of the simple tax things people can do. But literally, we can take it through. I actually did this program, Rose, for somebody else recently, and I got a call directly afterwards. Who a person heard me talk a couple of times.
Yeah.
Who's 50 years of age and knows that they want to exit their business, but they said, "You keep talking to me about this. I need to do something." So we're devising a solution. As it happens, his wife is involved in another business, so we're actually looking at a bespoke solution which would suit them. But there's no one size fits all. But so I think you need to
get your own tax advice. Okay.
Yeah. It depends. Like if your business is worth X, that may just be enough to retire on. If your business is going to be worth a multiple of that, you can say, well, okay, I need so much in my own personal hands or my pension scheme, but thereafter I'll have a surplus for investment. And you can say, well, how do you protect that from in the best way possible from tax? Or indeed passing it on to the next generation.
Okay.
So
we did have a webinar by a company called Harvest Financial, and they talked quite a bit about pensions and investments in that regard for business owners. So that detail is on our website. And certainly, Gerard, let's talk again about perhaps doing a program for business owners who are going through that value building stage, because as you said, you can't just show up and say I have a business for sale. You want to be going through these steps and going through the value chain of the various personas that you need to change, which is it's not easy, is it?
No.
Yeah.
Like it was easy, everybody be doing it,
Yeah.
So you got it. think strategically about where you're adding value to your customer, you know, and indeed adding value to whoever buys your business,
Yeah.
you know.
Yeah.
It's another part of this as well. I think we've all seen family businesses passed on to the next generation, which end up being a noose around the necks and necks of the next generation. So, I mean, if you create a good, strong business,
Yeah.
you are passing on something value to your children, you know. So,
Yeah.
you know, so it's value to them, it's value to you, it's value to somebody else. So, you
Yeah.
know, it's you know, so you can often, like I say, be creating problems for your next generation, and they become beholden to the business, which is
Yeah.
not good
Not
either.
what you want to do.
You
One
know.
last question, and it's from Saba, and it's really asking your thoughts on your opinion. And they say, as a starting business owner, I hear that government tax supports and incentives such as SURE, etc., are not very helpful. They have detailed criteria and may not be worth applying for them and prove eligibility. Any thoughts?
I think he's absolutely right. Sure is a particular scheme which is a PR job, to be honest with you. It's certainly, we've had people applying for it, and
Yeah,
it is just being painful.
really. Okay.
In some cases it's a slam dunk. It's easy, you get it, and that's fine. But
Yeah.
it's one of these things. I mean, it's to be honest, it's a bit like watching Yes Minister. If you want to see how civil servants kill something they don't like, you just bury it
Okay.
in rules, you know.
Yeah.
And the SURE scheme fits the criteria that completely. With that said, there are other schemes, you know, and because there is good funds out there, for the right idea, that the money is there, and I think also money is a lot cheaper than it used to be.
Yeah.
So, you know, so you should be able to transcend those things. I mean, certainly SURE has its place, but it's a sweetener.
There are other
It's
options.
not
Yeah. Okay.
it's not a reason, or it's not. Don't rely on it. You know?
Okay. Well, look, thank you everybody for joining, especially to George. We'll send out your contact details, George, on the email along with the slides that you've shown us today.
No, our details are actually on
they're on there. Great.
So,
yeah. And we have
good.
another webinar next week, next Friday, and it's part of this business growth series. We're going to be joined by Christopher Burge, who's the CEO of Spark Crowdfunding. So it's an alternative to, you know, there's, as you say, there are lots of options for funding your business there. And let us know any additional information that you'd like as an audience and as our client base and regular participants. Let us know what else you'd like to hear. We'd like to support you on your business journey. And so thank you everybody for participating, and see you all again soon. Thank you, George.
Thank you all. Thank you. Look forward to seeing you again. See you. Bye.
Thank you.